Hey, have you ever thought about this question? Why does the United States always have a large and persistent trade deficit? Let's look at a powerful chart, okay? I've compiled the current account balances of all countries in the world over the past 35 years. In this chart, the ones above are surpluses and the ones below are deficits. We've singled out the United States, China, Russia, Japan, and the oil exporting countries. Isn't it obvious that the US down here is basically single-handedly holding up the banner of trade deficits? Single-handedly shouldering it all, the US has become the world's most voracious consumer. To put it nicely, it's the biggest client in the world. This is actually one of the things that really frustrates Trump. He has repeatedly mentioned the need to reduce America's trade deficit. You see, as soon as he took office, his top priority was to start a trade war, imposing tariffs on Canada, Mexico, and China. Coincidentally, the three largest sources of US imports. So, while the official reason given was to retaliate over border security, drug issues, and immigration, many people believe it actually has a lot to do with America's massive trade deficit. Looking back through history, America's trade deficit has been continuously expanding since the 1970s. This phenomenon is virtually unprecedented among all countries in the world. America truly stands alone in this regard. So why has the United States accumulated such a massive trade deficit? And why is it that only the US is able to accumulate such a large trade deficit? Is a trade deficit really such a bad thing? Well, these questions might not be as simple as you think. All right, everyone, get ready. I think this episode is really interesting, but relatively speaking, it might also be a bit technical. If you find it too dense, I suggest you just take a sip of water or save it to watch later. And we can go through it a few more times together. Haha. A trade deficit is pretty straightforward. It means a country's total imports are greater than its total exports. In other words, it buys more than it sells. So when we analyze where this trade deficit comes from, the most direct way is to look at these two sides. Either the country's importing too much or it's exporting too little. If total imports are too high, some people say it's because foreign goods are too cheap. For example, in places like East Asia and Southeast Asia, labor costs are very low. On top of that, these exporting countries might also offer all kinds of subsidies or even be suspected of dumping. They're basically luring or deliberately attracting American businesses or consumers to import their products. What about exporting too little? Many people might say it's because American manufacturing lacks competitiveness, can't keep costs down, and can't compete with overseas companies and so on. But if you ask an economist or even an economics student what causes a trade deficit, they can immediately tell you it's because the economy's savings rate is insufficient. Surprised? Don't be intimidated. Let's dive into this episode's economics mini class. Through a series of very basic formula derivations, we can arrive at a very important equation. A country's trade balance equals its total savings minus its total investment. Let me briefly explain. Here, the definitions of savings and investment might be a bit different from what we usually mean by personal savings and investment. Total savings, as defined in economics, is simply your annual income minus your consumption. For example, if you earned $100,000 this year and spent $60,000, then the remaining $40,000, whether you put it in the bank, bought financial products, or purchased stocks, all of this is considered savings. It's not called investment just because you bought financial products. It's not called investment, it's called savings. So what does total investment mean? It refers to investments that genuinely boost productivity. For example, if you buy a factory, build a plant, or purchase equipment, these are what count as investments. When a country is completely closed off, with no trade surplus or deficit, its total savings equals its total investment. But how can it keep up? That's why people often say the reason for a trade deficit is insufficient savings rate. But let me tell you, this seemingly profound causal relationship is, to put it plainly, just a formula derivation. You could even say it's basically nonsense. It's like asking, hey, why did the water overflow from the cup? And someone tells you, because there was too much water in the cup, right? What we really want to know is why. There's too much water in the cup. Why is there too much water in America's cup? Why is America's savings rate insufficient? Some people will go a step further to explain this. Low savings means you might be spending too much, so it's because Americans love to consume too much. All they do is shop, shop, shop all day. The domestic market in the US can't satisfy such a huge demand for shopping, so they have to import from overseas, which leads to such a large trade deficit. Sigh, doesn't that sound kind of reasonable? So there's a Nobel laureate, Stiglitz, who believes that if Trump wants to reverse America's trade deficit, he should encourage people to consume less and save more. That way, the trade deficit would naturally decrease. There's also another explanation, which says that the US government's deficit is too severe. They spend too much and the savings rate is too low. It's a problem with the government, not with the people. So the US government needs to reduce its deficit, spend less, borrow less, and in this way, the trade deficit would naturally decrease as well. There are actually many similar arguments, and they all sound reasonable to some extent. However, in my opinion, these are not the main reasons why the US has been running a long-term trade deficit. In other words, everything I just said is basically nonsense. Why? Because this analytical framework is missing a variable, a very, very important variable that can be said to play a decisive role, the exchange rate. In our previous episode about foreign exchange, we actually mentioned that the exchange rate is essentially a conversion relationship between the internal price coordinate systems of different countries. This thing, honestly, it's like a devil. It's everywhere, and anyone who makes a move will affect it. And once it moves, it affects everyone. Now, since we're analyzing trade issues, how could we possibly leave out this devil, the exchange rate? For example, let's say the US dollar suddenly depreciates by 50% overnight, and suppose the price tags on all goods remain unchanged. For those holding non-US dollars, all American goods would basically be on sale at half price. iPhones, for instance, Nvidia chips would all be half price. Those Double 11 or Black Friday sales would be nothing in comparison. Just imagine how crazy the global market would go, right? I bet the US trade deficit would disappear overnight. Well, actually, I shouldn't say bet, I'm just saying. I'm giving this rather extreme example just to help everyone intuitively understand the impact of exchange rates on trade. When the exchange rate rises, imports increase and exports decrease, which leads to a larger trade deficit. Conversely, when the exchange rate falls, exports increase and imports decrease, resulting in a trade surplus. What's even more fascinating about foreign exchange is that it's not just a converter between different countries' currencies, it's also a highly sensitive automatic adjustment mechanism. What does that mean? It means that if you have a persistent trade imbalance, the exchange rate will automatically adjust your trade level through appreciation or depreciation. Let me give you an example. Take the country of milk tea. When it has a trade deficit and keeps importing, it needs to pay in US dollars. So it will continuously buy US dollars and sell its own currency, the milk tea currency. This puts depreciation pressure on the milk tea currency, and depreciation will stimulate exports. If it keeps importing, over time, this process will gradually reach a balance. Once a balanced state is achieved, the depreciation pressure on the milk tea currency will also disappear. So, if there is no human intervention in the foreign exchange market, the exchange rate acts like an invisible hand, adjusting things so that a country's trade level remains in a state of equilibrium. Looking at it this way, the reasons we just explained, such as American consumption or government deficits, might explain the US trade deficit in the short term. But in the long run, theoretically, the market should automatically adjust, causing the dollar to depreciate and gradually correcting the US trade imbalance. But in reality, the United States has had a trade deficit for nearly half a century. So we need to figure out why the dollar's automatic adjustment mechanism has failed and stopped working. This might actually be the key to explaining why the United States has had a persistent trade deficit. First, a very reasonable guess is that perhaps there has been human intervention in the market that has distorted the automatic adjustment mechanism of foreign exchange. For example, many developing countries, in order to maintain trade and economic stability, peg their currencies to the dollar, or their central banks may actively intervene to regulate the exchange rate. Through these artificial measures, the automatic adjustment function of foreign exchange is suppressed, and as a result, the local currency often becomes overvalued, leading to trade deficits. The IMF once reported that in the early 2000s, about a quarter of the world's currencies were overvalued, with official exchange rates more than 10% higher than black market rates. And as for the United States, it has indeed done this before. It has intervened in foreign exchange matters, but in the opposite direction, it wanted to devalue the dollar to ease its trade deficit. This is what everyone may have heard of as the Plaza Accord. In the 1980s, due to the combination of tight monetary policy and expansionary fiscal policy, the US experienced a significant appreciation of the dollar, which hurt American exports. This was especially true as exports from Japan, particularly cars and electronics, had a major impact. At that time, President Reagan essentially pulled in Japan, France, West Germany, and the UK, half negotiating, half threatening, and said, hey, things aren't going well for us here. You all need to step in and appreciate your own currencies to help devalue the dollar. Take care of our exports and help reduce America's trade deficit. This move was indeed effective. You can see that after 1985, the US trade deficit shrank noticeably. This was thanks to the depreciation of the dollar following the Plaza Accord. Of course, I want to emphasize that this doesn't mean the Plaza Accord was actually a successful foreign exchange intervention. There were many side effects. We won't go into detail about that today, but if we look at it purely from the perspective of how exchange rates affect trade, this is indeed a very good example. However, after this, the United States rarely intervened directly in the foreign exchange market. And even when it did, the scale was very small. And as you can see, after 1995, the US trade deficit continued to expand at an even faster rate. So it's quite clear that this persistent US trade deficit is not caused by the US government or central bank artificially raising the dollar's exchange rate. Well, it's already 110 now, and we're about to dive into the core of this issue. In fact, foreign exchange doesn't just automatically regulate a country's trade balance, but rather the overall flow of capital to and from the country. What does that mean? It means it's not just the capital flow resulting from selling goods and services, but also includes the movement of capital itself. For example, if I make a cross-border remittance, invest overseas, or buy US stocks, right? All of these are considered movements of capital itself. So the US has always had a trade deficit in this area. But if we look at the flows in the financial account and capital account together, wow, isn't it? What a beautiful and perfectly symmetrical chart. So this so-called automatic exchange rate adjustment mechanism actually doesn't have much substance. It's just that what people usually hear is only half the story. This chart, this is the essence of the video, shows the whole picture of the story. Listen, I'll break it down for you in detail. A country generally has three major external accounts: the current account, the capital account, and the financial account. Current account, capital account, financial account. Together, these three accounts make up a country's overall balance of payments. Balance of payment, turning into an English lesson here. Under the current account, the most important component is trade. In addition, there may be some investment income, dividends, wages, and so on. But trade is the main part. So many times people mix up the trade surplus or deficit with the current account surplus or deficit when talking about them later. As for the capital account and the financial account, you might not have heard much about them, but they are very important. They include all cross-border flows of financial assets and liabilities. For example, the FDI, foreign direct investment, in cross-border direct investment that everyone often hears about, or when banks, insurance companies, and funds from various places and countries buy US stocks and bonds, including when central banks of different countries purchase US stocks and bonds, these all fall under the financial account. For the balance of payments in most countries, the main focus is still the current account, which is primarily trade-related capital flows. But in the United States, it's different. The capital account and financial account, especially the financial account, see very frequent flows. And these funds are extremely flexible. So for the United States, compared to the current account, it is actually the financial account and capital account that play a more dominant role. Hey, don't get confused by all this. So if we look at these three accounts together, we get the chart we just saw. For the United States, its overall balance is almost flat. It's just that between the financial account and the current account, when one is high, the other is low. For a long time, the US has been in a pattern where the current account runs a deficit while the financial and capital accounts run a surplus. Basically, people invest in US dollars and then the US uses those dollars to buy goods from abroad. That's roughly how it works. The reason why the United States has had a persistent trade deficit for half a century is largely, perhaps even primarily, because of these continuous capital inflows, which cause the dollar to appreciate and thus lead to the US trade deficit. On the financial account side, large amounts of capital from all over the world flow into the United States to buy US Treasury bonds, corporate bonds, and stocks. This allows American companies and the government to have ample capital to invest, expand, and spend. From this perspective, the United States is actually a major beneficiary, especially Wall Street and internet companies, and of course the US government as well. Many times when you listen to American media or some politicians, they may only emphasize the good side, saying, oh, we have such a large trade deficit, making it seem as if they've suffered a huge loss and all the money has been taken by others. But in reality, this US trade deficit doesn't mean that the money has simply been taken away by others. It's more about the relationship between the current account and the financial capital account. It's just that there's an imbalance in this relationship. So once you understand this, it's easy to analyze. If the US only imposes trade sanctions on one or two countries or certain categories of goods, in the short term it might indeed help alleviate the trade deficit. But in the long run, theoretically, it may only restructure the composition of US imports. Originally, you might have imported from Canada, Mexico, or China, but now it could shift to places like Japan, Australia, or the European Union. As long as there is a strong demand for continuous inflows into the financial and capital accounts, it will be very difficult to alleviate the trade deficit. So you might ask, why is there such a large amount of capital flowing into the United States through the financial account? Some people might think it's because the US economy is strong and there are many investment opportunities. After all the major internet and financial giants are in the US. Well, that's true, but I believe the most crucial and unique reason is that the US prints the US dollar, which is the world's reserve currency. Let's take a look at how central banks in various countries accumulate their foreign exchange reserves. Take, for example, the country of milk tea. It exports a large amount of milk tea and earns a lot of money every day. Most of this income is in US dollars. In theory, it needs to exchange these dollars for its own currency, milk coin, so that the money can circulate within the country. This means businesses need to go to the market to sell dollars and buy milk coin, which would cause fluctuations in the price of milk coin. So, to avoid volatility in their currency, what do many countries actually do? Their central bank will tell these businesses, don't go to the market to exchange your money, just come to us instead. They give their US dollars to the central bank, and the central bank gives them milk coin. In this way, the central bank is essentially printing new milk coin out of thin air, while accumulating these foreign exchange reserves for itself. In other words, the amount of foreign exchange reserves a country's central bank holds actually reflects how much money it has printed out of thin air. You might be wondering, why am I talking about this? Well, hold on. The key point I want to make is, after the country of milk tea has accumulated such a large amount of foreign exchange reserves, what does it do with all that money? Do they buy gold with it? Usually not, since the US dollar is the main currency. So most central banks actually reinvest a large portion of their foreign exchange reserves back into the US market. For example, by buying US Treasury bonds, MBS, corporate bonds, and the like. Take Japan. It has over $1 trillion in foreign reserves, which it reinvests in US Treasury bonds, becoming the top US creditor. Through this cycle, trade surplus money flows into central banks and most returns to the US. This capital flow amounts to hundreds of billions annually. And it's not just the central banks of various countries. Insurance companies, banks, and funds are actually similar because the US dollar is the world's currency. And the vast majority of investment targets and commodities in the world are priced in dollars. The money people earn in international markets might be in Australian dollars, Japanese yen, or euros, but in the end, much of it flows back into US dollars and is invested in dollar-denominated assets. In this way, it creates a continuous financial account surplus and a current account deficit, an unbalanced balance. And if you look at the United States, the timing of when it began to run a trade deficit also happens to confirm this theory. You see, its trade deficit started right after the US withdrew from the Bretton Woods system. The US dollar no longer needed to be backed by gold. And with the establishment of the petrodollar, the US could continuously and boldly expand its debt and credit scale, which is what allowed this international dollar cycle to begin expanding exponentially. This is also why you see a very interesting phenomenon. The better the US economy does, the larger its trade deficit becomes. Think about it. When the economy is doing well, it attracts investment, the current account surplus grows, the dollar appreciates, and the trade account deficit increases. So from this perspective, the better Silicon Valley and Wall Street develop in the US, the more its manufacturing sector will naturally be suppressed to some extent, right? Let me quote a statement from the Federal Reserve, which can serve as a conclusion to the long chain of logic we've discussed today. When the United States can purchase goods from the global market simply by printing money or issuing bonds, it is destined to continuously run a trade deficit. The current international monetary system, which is based on the US dollar as the primary global reserve currency and US government bonds as the most sought-after store of value, is the fundamental reason for the United States' persistent trade deficit. You see, it's not just me making wild analyses here. Even the Federal Reserve itself has acknowledged this. In fact, there's really no absolute right or wrong about it, but sometimes certain media outlets or politicians will seize on just a small piece of this puzzle to make their point. What I hope is that after watching today's video and listening to this analysis, you'll be able to instantly see through their rhetorical tricks. Actually, what we've just discussed is known as the Triffin dilemma, or the Triffin paradox. Who is Triffin? He was a very famous economist. As early as the 1960s, he pointed out that any country issuing an international currency would inevitably fall into a trade deficit. Think about it. Back then, the gold standard was still in place. You could say he predicted the long-term trade deficit that the United States is experiencing today. When many people discuss trade deficits, they tend to see it as something very negative, as if it's extremely bad for the economy. People might think that if you have a trade deficit, you're buying things from others and letting them make all the money, which feels a bit like losing to other countries. But is a trade deficit really that bad, that terrible, that frightening? In fact, most scholars do not agree with the view that trade deficits are harmful to the economy, but you also can't say that they're good. If you really want me to sum it up in one word, I would probably use the phrase that most economists love to use, though it's a rather annoying answer, which is, it depends. We've analysed so much today, and I believe you should have a sense by now that a trade deficit is more of a manifestation, a symptom. Whether it's good or bad for a country's economy depends on the reasons behind this symptom. It's just like when a person's heart is beating very fast. Can you immediately say that's unhealthy? Well, it depends. If they've just run a kilometer or seen someone who makes their heart race, then a rapid heartbeat is actually a sign of health. But if it's due to myocarditis, arrhythmia, or palpitations, well, then you need to get checked out right away, right? It's similar with a trade deficit. If it's caused by strong investment demand or strong consumer demand, look, many countries that are in a period of rapid growth or have lots of investment opportunities have also experienced periods of trade deficits. For example, Australia has maintained a current account deficit for decades because behind this is its continuous attraction of foreign investment. If the heartbeat is fast, that's perfectly normal. But if some countries' economies overheat with excessively strong consumption and too much borrowing, for instance, before 2010, all the non-German countries in the Eurozone collectively ran trade deficits with Germany. Then, the money Germany earned from exports was invested in cheap bonds from Spain and Italy, which ultimately led to problems. When the European debt crisis broke out in full force, Italy, Spain, and Greece were clearly in a state of economic overheating. Otherwise, why would Germany be so eager to rescue them after the crisis erupted? I remember back then, Merkel would often gather the leaders of various countries for meetings. At first glance, you might think Germany really had the demeanor of a big brother looking after those little brothers. But in reality, Germany was actually the biggest creditor to these countries. So in saving them, it was also saving itself. Another problematic trade deficit exists. Take Sri Lanka. Its economy is collapsing, the government has huge foreign debt, and its currency is crashing. The central bank must artificially raise the exchange rate, causing a severe trade deficit and goods shortages. This deficit occurs in healthy countries, but also in those stuck in the mire. Thus, economists say, it depends. This video actually came from some thoughts I had when I was researching for the episode on tariffs. To be honest, it might be a bit theoretical since it involves a lot of reasoning and logical deduction. It's not really a storytelling kind of video. So for those of you who have made it this far, I really appreciate your effort.